Welcome, everybody. Great to have all of you here for today's main event. We're calling this, the LP Institute Insights, Lessons from Top Limited Partners. Really, though, today is a celebration of the fact that we're concluding the LP Institute's fourth cohort. Shortly, we're going to hear from two of our top graduates, and we're going to discuss learnings from the program, as well as insights into the evolving nature of venture capital. Following that, we'll do some Q&A. You'll see the kind of down below a place where you can, hit the Q&A button, type in questions. So as you're kind of listening to the panel, feel free to start populating questions in there as you like, and we'll have an opportunity to address all of those at the conclusion. So over the last 3 months, roughly, we've had about 60 limited partners who've participated in our cohort-based learning program that's really specific to individuals investing in emerging venture capital funds. And for those a little unfamiliar, emerging venture capital funds, there's no real specific definition, but we typically think of those as maybe a fund one, fund two, sometimes a fund three. And often they're characterized by being slightly smaller, which in a lot of ways makes them, in my opinion, at least a little bit more interesting. You look at the data, often you'll see that emerging managers tend to outperform, which makes sense. It's easier to return capital on a smaller fund, as well as the fact that, you're able to experiment. These are folks who it's kind of make or break, right? They're really trying to prove themselves. So it's a really fascinating space, but often is a little bit more qualitative than quantitative in some ways when it comes to due diligence. And so the idea of the LP Institute is really to help educate about this burgeoning asset class. I'm going to just give kind of a quick overview of the program before we get into the panel. So the LP Institute is an offshoot of a program called VC Lab, which is the largest accelerator program for new and emerging venture capital funds. The LP Institute really was filling a gap that we saw in the market, where as these emerging funds were going out to fundraise, they were often attracting what I would call a newer type of LP, what we call an emerging LP. And this can range both from, really active family offices already investing in venture capital, who are, maybe traditionally investing in more established managers, but really interested in first investments into the emerging manager section. And then also folks who are kind of net new to venture capital and see, investing in venture funds as a good risk-adjusted way to enter the asset class, as opposed to just investing in individual companies. This is probably also a good time just to point out, none of what I'm going to say or you're going to hear today in the panel should be construed as investment advice. These are all our own opinions. So the LP Institute program is comprised of 8 one-week sprints, which cover a whole gamut of things from sourcing opportunities to conducting due diligence. And when we say due diligence, that includes both sort of the human element, as I mentioned, that's particularly important with emerging managers, as well as operational, legal aspects, the traditional sort of sourcing, picking, and winning. And then successfully closing on at least one venture capital investment. The time commitment typically is about 4 to 5 hours a week. So, it's not nothing, but we still have designed the program to accommodate super busy schedules. The curriculum is very hands-on, as you'll probably hear both from Armin and Rajesh in a moment. But we really believe in this concept of learning by doing. So the goal is really to have everybody meet with 5 to 10 GPs throughout the program. So you're really there, getting to be in front of managers and building that pattern recognition. Along the way, you're going to revise your diligence process and develop it. You're going to be part of a working group. So we use a combination of both working groups and sort of AMA, Ask Me Anything type sessions to be a sounding board as you're progressing through the curriculum and doing your manager meetings. And then finally, we're having everybody select what we call a finalist fund. And often that ends up resulting in, folks making an investment into their finalist fund or finalist funds. And just a quick word on the common archetypes of folks that we see come through the program. As I mentioned before, it really, is a wide spectrum, but we have, active angel investors who are looking to get into venture capital. We've got high net worth individuals. We've got family offices and institutional investors, right? We've had in the past many corporate venture capital funds, as well as newer fund of funds participate. So it's really a fantastic group. And lastly, I just want to say it's really the community that makes this program special. And it's just been such a pleasure to get to know all of our participants across Cohort 4 and all of our previous cohorts. If you're interested in venture capital and in finance, it truly is, I think, some of the best networking in the world to participate in the LP Institute. It's just a phenomenal group of people, from across the globe. So a huge congratulations to all of our graduates. We know it's can be time consuming. It's not always easy to make busy, time in your busy schedules. But again, it's just been a really special program, and it's just such an honor to, get to know all of you and just see people evolve and kind of level up. And, again, in my humble opinion, it's just such a net positive for the ecosystem at large to have more dollars and more attention flowing toward emerging managers. So with that, I'm going to introduce both Rajesh Ranan and Arman Batomini. And I'd love for both of you maybe to just kind of quickly introduce yourself, maybe say a couple of words on your background, and then we'll move into the panel. So perhaps we could start with Arman.
Yes, hello everybody. So Armand, I'm based in Paris. So my background is more an operator. I was a manufacturing manager on oil field industry and then consumer electronics, and then switched as a CTO on a startup linked to IoT and green tech and mobility. And then I help companies, my company, like raising money. So I've been involved in raising and helping those guys. And then slowly I've been acting as an operating partner for portfolio startup, mentoring, and then I get to be more involved in the startup ecosystem here in France and Europe, and making few angel investment. And after you need just to kind of like double down on investing. So I was more interested in like kind of getting to the next level. So that's why I'm here.
Amazing. And Rajesh, how about yourself?
Sure. Hello, everyone. Great to connect to you all. I'm Rajesh, based out of Abu Dhabi, UAE. We have a global investor program. I work with a local corporate group, and we have program across the public and private equity. We don't do fixed income and credit, but within equity, especially on the private side, we allocate across buyout, growth, and venture. Within venture, we allocate to both emerging and established managers. I have been in the allocator space since last 12 years. And then before this, I was with UBS and Guggenheim on the investment banking side.
Amazing. So as you can see, we've got, two panelists with an incredible, wealth of knowledge. So I'm excited for this. So the first question I'd like to ask both of you is, what initially attracted you to the LP Institute? And how has the experience sort of shaped your approach to venture investing? Rajesh, it might be interesting to sort of hear from you first. Obviously, you've been in sort of the allocator space for quite a while as an institutional investor. So curious what attracted you to, kind of a program focused specifically on, emerging managers.
Sure. So first is like developing the network and creating a pipeline of managers. In manager selection, it's always good to see as many managers as you can possibly, because it gives you a better comparative judgment when you see a whole lot of managers, and then you have better ability to pick the best out of that. So creating a pipeline of managers and then networking with the fellow LPs and global managers on the same platform is quite useful as well. And most recently, if you have seen the market, most of the big managers have become very big. Like they have a huge multi-billion-dollar platform, even going above say 2 to 5 billion range. So they have become too big. So we have to find a new set of good quality managers where we have to allocate money to, because when managers grow big, returns deteriorate, and then you have to focus again on the emerging set of managers. So that was my key, say, motivation to connect to the VC lab and join the network for the future pipeline and with the fellow LP.
No, it's such a great point that you make. For those who, again, maybe are less familiar with the asset class, one of the big evolutions that we've seen are, some of the really large firms like a A16Z or maybe a General Catalyst, right, who have really scaled their platforms to multiple, billions of assets under management. And one of the things that's interesting is, at that point, it's fairly easy to get wealthy off of the management fees, right? Whereas in the world of emerging managers, those managers are really, especially with a smaller fund, not necessarily, crushing it on the management fee side. And so they're really, focused on the carried interest, right? Which is often sort of the 20% or so that once they, hit a specific hurdle, they're able to keep. And so there's such an interesting alignment of interest on the emerging manager side. And I think it's a really astute point that Rajesh brings up around the bifurcation that we're sort of seeing in the market of some of the bigger firms continuing to scale up AUM, and then sort of the rise of these, kind of smaller, more craft funds who are a little bit more focused on carry and arguably maybe better aligned with LPs. And Armand, how about you? What attracted you to the LP Institute, and how's that sort of shaped your approach to investing?
Yeah, basically, I'm a tech guy. I'm an engineer at heart. So, I've been exposed as a CTO, to one company, you do consumer electronic, then you switch company and you do IoT, and so on and so forth. And I always wanted to be exposed to more technology, more diverse technology. So, like naturally, getting to interact with GPs and manager is a good way to be exposed to their portfolio and get to know about the new trends, in a different way, kind of efficient way, and also seeking for more impact for this VC investing. So this is the reason why, like slowly, I get to connect in this VC network. And the early stage, it's very natural for me because like this is more tech meeting finance than starting with a big firm where it's more analytical and stuff. So it's easier to understand as a tech guy, starting on the pre-seed investing. So this is the way I got to know there, and being exposed to people and advising family offices and advising VC for their portfolio, for due diligence stuff, and then you get to get involved more. And then after a certain moment, you say, yeah, why am I doing that for myself? So this is the way it started.
I love it. I love it. I love that idea of transitioning, from more of a consulting capacity into, investing your own dollars when you really see the opportunity.
Yeah, exactly.
And you mentioned trends, Armand, and we're going to get into that in a second. I just want to ask one other question. How has the program, sort of impacted your confidence or decision-making abilities as an LP? I mean, we have, a pretty robust curriculum. You're out there meeting with managers. I'm curious, is there anything specific that has really helped you feel more confident going into, meetings with GPs or sort of building conviction to write a check? Armand, happy to stick with you on this one.
Yeah, sure. Like the program helps a lot because first, it's hands-on, is learning by doing, and the more you meet manager, the more you can kind of like fine-tune your process and your way. And for me, it was the best way because, as a tech lover, when you meet GPs, everything is fine, everything is fantastic. So you would invest like in all those funds, So having like a very structured process and adding some very practical criteria to your process on top of like the gut feeling, which is really important as well. But too much gut feeling is not good. And like a good mix of gut feeling and like a steady process helps. So this is why I got from the program a broader range of criteria and a process to kind of get to be more efficient to evaluate manager and make sure like you don't forget any point before making a like important decision.
Yeah, no, it's such a great point. People in venture capital often talk about developing intuition or in gut feeling. And to some extent, I do think that works, right? When you're, evaluating founders. And obviously some of that comes into play with, evaluating funds and GPs as well. But with so many funds in the market, right? I think one of the tricky things for a lot of people starting off is that everybody sort of looks good, right? And so if you haven't met enough people and you haven't sort of developed that pattern recognition, it can be a real challenge to be able to do those sort of initial filters when everybody on paper is pretty impressive. So I think that's an excellent point. And Rajesh, how about yourself? Anything specific that's kind of helped you build some confidence when it comes to evaluating emerging funds?
Sure. So just to make it very clear, when you allocate across different strategies, venture is the most difficult one to do due diligence and assess. Buyout, growth, other strategies are very easy. Within venture, evaluating emerging managers are even more difficult. You don't have any data point like you have in, say, established manager case where you can analyze portfolio, you can analyze performance and all that. So it's very difficult. And I think the program helped me reiterate this concept a lot over last 3 4 months, because you know this point but it's always in the back of your mind, and you always look for some data and some kind of hardcore analysis which is not pretty much prevalent in your emerging manager space. There you have to focus more on the people, you have to focus more on the references and other stuff. So that reiteration process was very helpful, where I need to refocus my attention somewhere else rather than the data. And obviously, with all these data points, collection of manager at the same platform, where you have organized it and segmented it on the platform is very useful in a screening and everything. So that's also helpful.
No, that's great to hear. So I want to ask you both a little bit about trends, and I'm really excited for this part because I know both of you are curious people. You're seeing a lot of stuff out there, so I'm curious to hear what's getting you excited. So the question is, what trends are you most excited about that are kind of currently shaping the venture industry? Rajesh, maybe we'll stick with you. Curious to hear
Sure.
what's got you excited.
So it's difficult to find a VC manager these days who don't invest in AI. So
Yes.
so and that's what I'm most scared about, because valuation is crazy. So not just AI, robotics, defense tech, space tech, you name all these things, and valuation are crazy. And that's the thing that's trending, and everybody is going after that. So that makes me a bit cautious on any manager who is just chasing .ai kind of deal. We have to see a lot of undercurrent or area or sectors where attention is not there, where you can find very reasonable valuation, but still growing businesses and all. So in fact, I don't want to follow the trend, to be
Yeah.
honest. That's the market. I want to and especially if you see, I have looked at some of the manager on the consumer space,
Mm,
where I found very good performance, very good exit, and they are not chasing very high in valuation where, say, everything is overpriced. And sometimes it makes you feel like whether you are in 21 peak and what will happen after this. That trend is very obvious. And the other trend we already discussed on the big getting bigger, and most of the fundraising that is happening in the market is going to the big players. The new ones are struggling to raise in this market environment. I'm seeing them, the funds are open for more than 2 years and they're still not able to close the fund. mortality rate is very high. In my experience, when you back first fund, and after a few years they are not in the market, so you have to be very cautious on like picking the right ones when you do that, because you are in for 10-12 years, and by that time you reach at say harvesting stage of the fund manager is no longer in the picture, so you have to be very careful. So uh, yeah, I mean, follow the big names, but try to optimize on the emerging managers as well, where you make the right pick.
I love that. Two great points there, both around trying to be a little more non-consensus, right? Which is really the way that you make money in venture capital. So I love that you're interested in, kind of the consumer side of things, which it feels like there must be such an opportunity with AI. Everyone's talking about B2B and blah, 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 infrastructure, dev tools. But I mean, the consumer side, I think, is going to catch up quickly. So yeah, really, really excellent point there. Armand, how about yourself? What's got you excited?
Well, I would say that since I have I'm an electronic engineer background. What I see is like, before like 10 years ago, I was a bit frustrated because investing was all about like software platform and, hardware was kind of the dirty things. And you can see that hard tech in general is coming back because AI means computing, and you have all this layer in the industry where the computing, the chip architecture, everything is coming back, the robotics, the space tech, the IoT, all of this is hardware combined with like very low level software. So there's a lot of opportunity on that, and which is a good thing for a new manager with a technical background, because to make a dent on all this field, you need to really like focus and select a niche product. So you will see like PhD guys who are very focused on one AI vertical with a lot of opportunity, but you have to be kind of tech savvy to understand what is the vertical or the industry they're talking about. And there's a lot of innovation there. So it's important like to be kind of like acquainted to the architecture of the new technology. When you speak about AI, it's such a broad field, and it could be vertical to kind of like reboost old industry, as a digital transformation, or create new trends because of new chip architecture or robotics and so on. So I would say deep tech in general is coming back, because back to the time deep tech was seen as a risky stuff. But we get to the trend, like when we talk about deep tech these days, is like we're talking about startup who already pass the research phase and are about to like really go into market. So there's a lot of opportunity, but it's really techy. It's really techy. So this is that's kind of a very appealing, because as an engineer, then you can spend time to say, okay, this is maybe an untapped territory where I can invest, because a lot of people are just following the trends. And most of the time, as an investor, you have to be counter wave. So I'm kind of like excited because there's a lot of niche field that are coming on all this opportunity of investment. So yeah, deep tech, art tech, and also like the mobility stuff, which I'm really interested in. Like I'm a bike rider, and there's a lot of innovation on e-bikes and all the IoT platform that help to invest on it. And so yeah, green tech and deep tech are the things I'm following.
I love it. Yeah, I mean, deep tech, green tech. I hear you saying sort of, you're really interested in that world of atoms over bits in some ways, and I agree. I mean, I think it's such an interesting, area. I think back to an investor, once told me he was really interested in hardware because, software is amazing, but software can't pour concrete or build houses, right? And so that interesting intersection, I think, of AI and the world of atoms is going to be, really
And
huge.
there's another thing also, is like everybody talk about AI, but you need to understand that AI means energy. So there's a big energy revolution. So there's a lot of startups that are linked to the energy industry, like micro nuclear stuff, software and artificial intelligence to optimize energy consumption. So like the energy field is a very complementary industry to follow. I mean, if you're interested in AI, you should be interested in investing in energy, basically. So it's also a good trend to follow.
Absolutely. And then would love to ask both of you, are there specific attributes or strategies that you think will kind of define the most successful LPs in coming years? We've talked about a lot of these new trends. So kind of curious, like, what do you think, the best LPs are going to be able to like bring to the table, or what are they doing to sort of like level up, to prepare for some of these opportunities coming down the pipeline? Armand, maybe we can stick with you for that one.
Yeah, to keep up with what I was saying, like at least at the early stage, on pre-seed and seed, I mean, I guess the new manager were very focused on feed, where they have a strong ecosystem to kind of like identify very early the new trends, the good deep tech startup like coming out of university or incubator. Those guys have the proper ecosystem to identify very early stage, because it's a game of being very early and get to know that before everybody. So I would call them the niche guy. I mean, for me, this is the one that's going to make like the best performance for sure.
I love it. So sort of niche and having specializations will be important.
Yeah.
Totally agree. Rajesh, how about yourself?
So for me, we are more focused on, say, picking the best manager and not necessarily picking the best theme. I think that's the job of the manager. I would leave that to them, and finding the best manager is where I'm more concerned about. So that's first thing. And second, it's a difficult fundraising environment. Well, that gives LP an opportunity to negotiate better fee terms, better LPA and everything. For example, many VC funds you will see no hurdle rate. And in that was fine when interest rate was 0, but when you have rate at 5%, that's not fine. So you can negotiate things like that. Then you can create, say, good data rich analysis, because you already had data, but with tools like OpenAI, Cloud, and all, your analytics can improve a lot. So automating your own stuff on the LP side in data analysis and everything you can do double amount of work with better quality in short period of time. So I think LP should be more aware of using those tools and practice them in their work.
Yeah. No, I think it's a great point that you make too, around really optimizing to find the best managers, right? Especially in the emerging manager category, venture at large, really, there's just such a high dispersion, right, between the best managers in sort of everybody else. So the ability to find that 5-10x fund manager, really is sort of like the key for, outsized returns and outperformance. So yeah, totally agree there. And then maybe, we've kind of talked about this a bit, but, I'm curious, is there a reason why both of you are putting capital to work right now? Why you think, this moment in time is sort of a good one to, be allocating into, and, why is now a good time to be investing? Maybe Armand, we can start with you.
Yeah, like what I learned for a lot of mentors and people like Marco or Adeo, like you have to be always counterweight, because as you was just said, like capital is a bit scarce these days. It's very hard to raise for the startup, for the GPs. So it's the best time to invest, because because you get to the best deals, you get to better conditions. So this is the reason. Like you need most of the great startups were created in very harsh time, like after big turmoil. So I think we are in this kind of phase right now. So it's the best time for me to invest.
Absolutely. And Rajesh, how about you?
Sure. So on the one hand, you get say super cycle in terms of tech investing because of AI, robotics, and all those stuff. So that's one reason. Second is like the things which are not hot in the market right now, valuation reset is there. So you can get very attractive entry point there. So that's second thing. But having said these two things, I believe maintaining a vintage consistency is very important. So being disciplined because you can't time the market. You never know whether this is the right time or next year is the right time. When you talk to manager, every manager says when they are coming to pitch you, that's the best time. So, so you have to be very disciplined and consistent in your vintage allocation and consistently keep allocating every year so that you don't miss a particular year or don't over invest in a particular year. And that's how you can probably reduce risk on your side.
Such a great point. I think, both GPs and LPs, I think, sometimes struggle with this concept that, vintage consistency or diversification, really matters. But when you really sort of peel back the onion and look at the data, it's just so important, right? And I think that's one of the nice things if you're, looking to get into venture capital and you start with funds is you do get, a little bit more vintage diversification entering a fund just because you're diversified across a portfolio of investments as opposed to just making a couple of angel investments because yes, the timing is so important both on the entry side and even arguably more important, right, on the exit side. So yeah, really fantastic points. So we've got two more questions and then we'll move over to Q&A. So I see there are one or two questions in the Q&A already, but please feel free to ask anything you want. We've got two fabulous super knowledgeable folks on the panel up here. So feel free to ask questions whether it's about the program or other questions you have about venture capital, LP related anything. So I'd love to hear from both of you. If you were mentoring a newer LP, what's the top piece of advice that you might offer them? Arman, maybe we could start with you for this one.
Yeah, sure. I think one of the very important thing is to no rush, don't rush, take your time to engage with as much GP and manager as possible, just to practice to get to know those guys because it's at the end it's a very human thing. So you need to make sure you get to know them and iterate discussion with them, and also diversify because if you want to spread the risk, like what I would advise is not to only focus on one manager. I mean, if it's possible. So I would say like taking time and diversification.
I love it. Two absolutely key points there. And Rajesh, how about yourself? What kind of advice would you offer to a newer LP?
Sure. So I agree with Armin on the point where he's saying take your time. I mean, a lot of manager push you to do things faster, and you have to uh, manage the time at your end. But yeah, I mean, for new LP, I would suggest that negotiate downside first before thinking about upside. So when you are negotiating terms with your GPs and manager, focus first on the downside protection, like they do when they do their portfolio investing. They most of the good manager try to protect their downside first. So you should think the same when you are investing in manager. And I think two other points would be mostly on the picking up people because you are investing in the manager. So pick the right people rather than picking theme or picking pitch decks. You see a nice story in the pitch deck and then you jump on that without going in detail. So you have to avoid that. And then you have to, I would reiterate my previous comment on maintaining discipline and consistency in your vintage diversification.
I love it. And, just to reinforce that point around sort of picking the right people, right? Venture capital is a people business, right? And so you really need to be investing in people who, you want to be in business with, right? And have a lot of integrity. It's such a, key aspect. It's, an easy thing to think about, but, sometimes gets overlooked in, to your point, in people's just, interest in some new hot sector or FOMO or something like that. But being able to sort of take the time to really get to know somebody and feel comfortable with them, the vibe, right, matters. So yeah, that's a really excellent point. And so last question that I've got for both of you, would love to know if there's something that, you wish you knew now, that you'd known when you first started investing in funds. Is there something that, you wish you could kind of go back in time and tell your, kind of more novice LP self? Um, Armand, maybe we could start with you, unless you need a minute to think on this one.
No, I'm just well, I'm quite new to like LP investing, so I guess it's more like, yeah, just uh, I would say being sure of your own investment thesis, because the GP, the fund has a thesis, but you as a LP, you should have also a thesis, and kind of like spend the right amount of time to have clear idea about what is it that you're doing there. I mean, why are you investing? Because sometimes, yeah, okay, I want to do that, but just take your time to make sure that you ask yourself the right question before jumping in, and make sure that you are structured on your goal of investing. Why, what sort of field, industry, and what is the thing that you are attracted to. So I think it's very important, like first to work on yourself, and then make sure that then it will help you to interact with the GP, and make faster decision, because then you can eliminate things that are not in line with what you are looking for. So I guess this is a good learning.
Yeah, it's such an important point. I think that idea of having a thesis, and obviously it's one of the, big aspects of our program at the LP Institute, is that we're trying to help people be able to articulate, right, what you are specifically looking for, what's kind of your sweet spots, so to speak,
Yeah.
when you're investing. Because yes, there are so many, it's easy to kind of get lost in all of the different opportunities that are out there, or succumb to FOMO or something like that, right? So really being able to articulate a thesis and invest against that is really important. And Rajesh, how about you to sort of close out?
Sure. So on my end, I'll try to bring in point on the reference check. Mm, I used to do a lot of reference check, and most of the time those references used to come from the manager themselves. And you never used to get, say, bad reference from anyone because if they are giving the reference name, they will always talk good about him. So when you are doing reference check from your end about the GP, you have to manage within your own network, find some common connect, and then try to find whether he's good or bad. If it's coming from the manager himself, it's very rare that you will find anything bad about him. So that's first thing. And second is like negotiation on the side later side. In the beginning, it was very difficult. Now I'm more confident and say I push back a lot and try to negotiate better terms, and even find side letter very easily. And within that, I mean, when you're talking with an established manager or good manager who gets oversubscribed very easily, it's always good to go in first clause and negotiate those side letter, because once they get the traction, you will not be able to negotiate. Uh, on not so hot or in demand manager, you have time, because they might be fundraising for 1 or 2 years, they get tired in the market, and then probably will still have time to negotiate those terms. So side letter negotiation is another thing.
Well, I really love your point on references. I think that just goes to some degree, to highlight just how important due diligence is, especially in the world of GPs. And, obviously I'm biased, but, the importance of a program like the LP Institute, because on the surface level, right, I mean, if you're starting a venture capital fund, you probably have an impressive resume. That's kind of the bar just to, get started. And so that ability to kind of peel back the onion, find, kind of common connections, get an off-book reference. And again, it kind of goes back to really trying to work with people, right, who are high integrity. So I think that that's such a great point. So, a huge thank you to both of you for participating on the panel. I think that really highlighted, some of the great stuff that we do in the program, as well as, so interesting to hear your thoughts on the ecosystem at large, advice you would give to, newer LPs, and of course the sort of trends that, have both of you, so interested. So maybe we can move now to some Q&A. We've got a question from Ian here on what is the preferred way for an LP to hear from a fundraising GP for the first time? Do either of you want to take that one first?
I would
So,
say,
yeah, go ahead, Arvind.
yeah, I would say first, you can leverage the program because there's a platform called Decide Pro. It's kind of a platform called that a marketplace for GP where you can select very curated GP. So it's very convenient because it's like everything in one place, and you can really go faster. I mean, it saves your time a lot. So this is the first way, and I would say for the rest, like it's leveraging your network, because as a LP, you should connect with other LP, connect with VC fund, connect with startup who knows VCs, go to trade shows, to startup shows, and so on and so forth. So it's really a networking game because some people will not share because they want to be the only one to get the best deal. So you need to network and connect. Really, that's the bottom line.
Absolutely. I think network is so important there as a filter. There, Rajesh, how about you? Any thoughts here?
Yeah, so I'd use a combination of approach. So for institutional LP, of course you have platform like PitchBook, Preqin, and many other databases. But for non-institutional players, like it's more important to engage during VC events, participating in that, and then creating your own network around that. Platform like VC Lab is another example to create a sourcing funnel for your first time fundraising managers. So yeah, combination of participating in events, networking, platform like VC Lab. You have many other platform like ILPA Institute and a few others in the market which you can explore.
Awesome. Well, we've got time for one or two more questions. If anybody has one, we'll give it a moment. But yeah, just want to again thank both of you and just highlight that, I mean, each of the cohorts is special. But this was just a really fantastic group of LPs, I think that we had. And I think back to some of the mentor sessions, I think those were really fun. So just want to thank everybody who participated and who's watching this. And if you're in the audience and you're one of those folks who's kind of considering joining the next one, we would love to have you. We had a hand raised. Is there a question? Feel free to type it in there. We'll give you another few seconds. Otherwise, we'll wrap a little bit early. But yeah, this was really great. I feel like I learned a ton, and it's always just such a pleasure talking to both of you. I feel like I learned something new each time. So, all right. Well, I guess no other questions. So thanks again, both Armand and Rajesh. It was really fantastic, and we'll see all of you back at our next event.
Thank
Sure.
you.
All right. Congrats.
Thank you.
Thank you.
Bye.
Congrats
Bye-bye.
to all our grads.
Thank
All
you.
right. Have a great
Bye.
one, guys.